Hello and welcome to another episode of Help Me Buy Property podcast. This is going to be a special one. This marks 3 years worth of our podcast, the third anniversary. Wow. The 3 deep years of us having property conversations. So let's have a walk down the memory lane, look at how far have we come and what's changed in the Australian real estate world. Now, as I sit back and look, I honestly feel gratitude. I feel start with something really simple mission to educate, inspire, and empower people to invest into property. It has turned into a vibrant community of more than 11,000 people. Over the past 3 years, this podcast has become so much more than just the conversations about brick and mortar. It's gone data-driven market analysis to investment strategies to tech-smart structures to real success stories, and it's been a quite roller coaster ride. When we started this year, the property landscape looked very different, and the elections were literally around the corner. The investor sentiments was shifting, and the interest rates were doing their own dance. And so we touched on all of these things, keeping in mind that we wanted to educate you and help you make smart, confident decisions about property investing. So this season, we had some amazing guests from all walks of real estate, covering everything from buy and hold strategies to renovation flips to co-living spaces to data-driven suburb analysis. We talked about how to structure deals, how to manage risks, how to think long-term and not just about immediate returns as well. You and I right here saw the interest rate dynamics evolve, the rate cuts, the new government policies, the rental reforms, the first home buyers grant and or guarantee scheme. These weren't just market updates, they were opportunities. Now, let me take you through some of these incredible voices that we've had on our show for the full year. The first and foremost, Mr. John Lindeman, my own property mentor, the property veteran, the guru, the go-to market analyst. He joined me to unpack his monthly predictions about real estate markets and what really is shaping the next cycle and where should we go look. And we, did the analysis together. Another memorable guest was Nikki Talbot. She shared deep insights into, property management in Victoria, breaking down complex compliance requirements and energy standards that helps, investors scale up their property portfolio, explaining how proper planning can cut costs and boost efficiencies and keep properties future ready for all of these minimum rental standard changes that are literally around the corner. We had seasoned experts, Sohail gracing the hot seat once again this season. He went deep down into risks, the setups, the exits of SMSF-backed property investing, a conversation that saved many headaches for a lot of investors who were listening to us. Now, one of my favorite episodes was Luke and Sarah Boyle, how they came up as a client, later became part of the investor journey and investor partner group family. Sarah and Luke shared how they bought 3 properties in a year, planned their wedding, and joined the investor partner group team. And the best part, their story was so relatable with a lot of Aussies out there. Talked about, balancing their personal life to, the mindset, the property goals, turning all of that into a long-term strategy rather than just, a short-term goal. We had Sid Sharma, who was a guest with such a pleasure. We talked about rent vesting, we talked about rooming houses or co-living properties, or how investing in high-yield properties doesn't necessarily mean that you live in them too, and how do you go around managing them in a perfect way. Each guest brought a piece of puzzle, whether it was policy, numbers, vision, or hands-on experience. We also had some other memorable guests like Rajan from cash flow real estate. We had Chris from unconditional finance, Julian, Aaron, just to name a few. So now let's recap some of the memorable moments and relive some of the moments from season 3 that are my personal favorite. RBA not dropping the rate, APRA not changing the serviceability buffer. What do you feel like? Should they have cut the rate? A, B, when is that going to happen and how pronounced it's going to be now?
I think what they've done is sort of the RBA. I look back at the history, and a long time ago, the RBA was freely, putting in rate cuts of 0.5% and more. It was quite common, or even increasing rates by the same amount. And they just seem, since 2012, they haven't done that. They've only been decreasing them by 0.25%. Or even less on once or twice. So I think that by delaying it, they sort of forced themselves to have a bigger rate cut when it occurs. So if it's next month, they might have to cut rates by 0.5 percentage point. And I think that that's something that they will simply not be able to avoid doing. And that's going to provide a big impetus to, the first home buyers and investors into the property market.
Do they have to buy property to begin with?
It's true.
Right. And whether then they go, well, actually I can, if I decide to buy property, I'm going to buy REITs or whatever instead, or I'm going to do fragmented ownership where I don't need to buy a whole property and so on, or I'll just trade it on crypto, whatever that might be. I think there's so many options there for the Gen Z and beyond, that property is going to become less of a need to have for a lot of people. But I guess the question is for those that want to get into the space where there's still a little bit of that traditional need for ownership and security, or leveraging property in the long run. The question is then, what are the challenges they're going to face? Are they, is it impossible to get in? Or are there some solutions? Is the government helping with anything? I think those are the things we can
Definitely
talk about, because I do think that whole generation from then Gen Z onwards is going to be, they're going to have a totally different view to property.
The legislation is changing that a property must meet these rental minimum standards prior to it being advertised, which I think is excellent, because there are properties that are on the market, and I know, because I actually saw one about 3 weeks ago that does not meet rental minimum standards. There are nails, hooks, boards, all sorts of things hanging out of walls.
Yeah.
And yet the property is on the market for rent, and people aren't renting it for that very reason.
And a lot of people don't understand that, a lot of these, I call them compliance regulations, right, are in the best interest of not just the tenants, but also landlords, right? Because it's also protecting them against the risk of an insurance claim being denied.
Correct. Exactly right. Exactly. And that's spot on. Like if your property doesn't meet rental minimum standards and it's unsafe, and you make an insurance claim and it's found that the property was unsafe, well, you won't be covered.
Yeah.
So it's in your best interest as an investor, but also as a homeowner, to make sure that your property is safe and secure for the people that are living in there.
I wanted to learn about real estate. I just did not want to buy properties. I wanted to first get some knowledge. And I wanted to also work in the industry, because that's the real game changer. You don't get good deals if you're outside the industry.
Yeah.
So I was looking to get a side hustle in real estate, and I actually did a buyer's agent course from Australian Property Academy, which is developed by yourself. And that course actually taught me how to do all the due diligence, how to research and pick up the best suburb. And it's doesn't end just at the suburb, right? There are so many red flags with the houses, etc.
100%.
So all those hundreds of parameters, different tools, like I didn't even hear a lot of the tools that I learned after doing that course, that how you could validate all the data.
Yeah.
There are hundreds of tools, but you had the best tools, I must say. So that actually gave me so much knowledge, and I could research and buy properties myself.
Lender's mortgage insurance is when you don't have the 20% deposit. We kind of know that. But there's what they call LMI bands.
Yeah.
Okay. So if you have a 15% deposit, so an 85% loan to value ratio, that's considered quite safe because you're nearly there with the 20% deposit. So the mortgage insurance is less.
Yeah.
10% deposit, which isn't exactly true, because I hear all these people talk on YouTube, you need a 10% deposit. No, you actually need a 12% deposit.
Yeah.
Because the LMI is usually 2%.
Yeah.
So you need to be at 88% to then add on the 2% to be under 90%, because under 90%, you then get your interest you get your repayments at interest only. If you go above 90% loan to value ratio, you then have to pay P&I with a lot of lenders, with most lenders on an investment loan. And then there's some banks, Commonwealth Bank will do a 95% loan to value ratio, which means you don't need a 5% deposit. You need almost a 7 and 8% deposit.
SMSF loans, been around probably for 6, 7, 8 years now. Not much acceptance from banks, but they're getting a lot better around understanding the process and what's required. And I guess clients are looking at that now as an investment strategy themselves on our first SMSF purchase. And there's numerous benefits. I mean, we can't go into all the tax benefits, but from a lending perspective, anything you buy, so any debt held inside that SMSF doesn't impact your personal borrowing capacity. So if you're looking at borrowing in your personal name or your personal trust, that debt is isolated, that debt is excluded as well. From a tax perspective, I'm not an accountant, can't give official tax advice, but when you do reach retirement age, any gains you get in that property, traditionally you pay capital gains tax. You could sell that property if you choose. There is no capital gains tax on that as well. So it's a good strategy to use your lazy superannuation.
Football players are contracted.
Yeah.
1 year, 2 years, 5 years, 4 years. So if you're 6 months out and you don't have another contract, then very difficult to get finance.
Really? Okay.
However, if you've got a 1 year contract and we're applying for a loan at the beginning of that 1 year contract, that's fine.
Yeah.
Still a 30-year loan, yeah.
Okay.
Yeah, because the bank, even though that the majority of people in the bank approving the loans and the rest of it will know who these people are because there's a good chance they've seen them on TV or working on the weekend.
It's quite interesting, right? Because they know that these people have a finite professional life, right? Their contracts would finish off in year 8 and year 9. And there's a lot of ambiguity around what is this person going to do after year 8?
Yeah.
Might turn themselves into a coach or buy another business.
You need to be careful of flood is one of the big ones. You need to be careful that you're buying in an area that's, got growth or doesn't have growth, which you can, you'd find that that's quite a big one. You'd need to make sure that there's a low vacancy rate and look at things like days on market to find the right area that you're looking in. Make sure the house is solid. Once you're building a pest, you'll find out if it's got structural issues. You've stopped pest issues, termites. But basically, I think at the end of the day is just be, open to looking at all areas, open to accepting a property that may not be perfect because the outcome and the growth will be there. And it's just one of the, it'll all come together in the end.
It's the worst investment if you are building in an estate wherein that co-living provider is building hundreds of those in the same estate. It's only logical that the fulfillment will be a big issue and the property will be empty. As long as you're building in the right locations, you are really, really going in established areas.
Infield areas, you mean?
Yes. Yeah. So as long as you're really, really going in the infield areas and even choosing to demolish an existing rundown house so that you don't compromise on the proximity. Yeah. Because ultimately, why it's worse? Because if it's empty, it'll leak money.
People do make the mistake of overcapitalizing. So they will buy a property, they want to renovate it, but then they get a little bit emotional about it and then decide that they want to add this and add that, and it doesn't really do that much for the property. So you really need to understand the demographic. What does the property in that area actually need to be right for the market? You really need to understand what's where you should be spending your money, because overcapitalizing can be an issue, and also getting a little bit emotional. Maybe you're buying in an area where the families living in properties are happy with laminate bench tops in their kitchen, but you're wanting to put in a 40 mil stone bench top, which is going to be a lot more expensive. Then that's that could be a bit of an issue as well. In terms of other factors there, sometimes people try to chase really, really high yields and get that positive cash flow. But then that's going to be really hard to necessarily get the strong capital growth, because people start looking at towns that are very regional, that don't have a lot of growth drivers, or maybe mining towns that just have like a one industry town essentially.
Data is a key indicator for us, and data gives us history. And if the history works in the favor of our landlords, that's what we want to make sure that it does.
Definitely.
We go out into different areas on monthly basis. We sit down and we look at new areas, new opportunities, and what is coming in the area. First of all, we go down to the suburb. We look at what kind of government funding is coming into the area, what hospitals are here,
infrastructure,
what school zones are here, the type of people, how many renters versus how many homeowners are living in the suburb as well. So there are a lot of data sets which are basic that we look at before selecting a suburb. Once these data sets have been achieved, we would now understand that, hey, this suburb, from the top of the look, it looks perfectly fine.
Yeah. So what you're basically doing is you're looking at areas where the rental affordability is high, but the amount of houses available for rent is very low. And so that's the disparity that you're basically looking for.
People think that they can buy a home where they can live in. It's not possible. You can't do with SMSF money. You can buy a property investment with but you can't buy a property where you can live in. There's another misconception that after you turn 67 or you reach your retirement age, that property, you can move in that property. It's not that simple. You can live in that property, but you need to transfer that property from SMSF to yourself, and it's going to be tax free, no doubt. But you can't buy, as you mentioned, dream home in US.
One of my most favorite things when I ask them what they want to achieve and they say passive income, I said, well, do you know how much passive income you want or you need, and how much your life costs you, and what like you would do with that passive income? And they say all the time, they say no. And so they haven't really thought about what a portfolio can do for them and how. And it's just, everybody knows that investing in property is a great thing to do and it can make you money and it helps you later in life, but they actually don't think about what they want that portfolio to do for them. And I get the answer, I just want to make money. And it's like, great, but what are you going to do with that money? What does that money mean for you? How can you use that money to better your life or your generations to come and things like that? So having a really solid idea of what your plan is, because if you've got a plan, it makes it easier to move forward and have the right people around you to make it happen.
If we can close 1 to 2 deals a week each, if you work that out, we're making a lot of calls. But, you probably look at 50, 60 deals. And you might narrow that down to 10 that make the cut. Go through the due diligence phase and make sure that they make sense. And then from those 10, you might put offers in on 3 and then get 1 deal over the line.
Yeah.
So it's
a lot of hard work, right? I think a lot of people tend to almost downplay this when you're talking about like 40 to 50 calls a day over a period of, and, majority of the times you're working 6 days because Saturday is one of the, hottest days for us.
We had a DA decline, which we can present to say, hey, when this isn't a development site, it might not go ahead, but we need to acquire the site. So we had 3 borrowers or 3 guarantors that were looking at purchasing this property. The story that we need to present is, why would 3 parties together decide to buy a site like this? So I had a bit of a chat with all of the borrowers and understood a little bit about what they were looking to do. And the idea was that if this doesn't end up becoming a development site, we'll live here, we'll have this as an Airbnb, we'll have this as a holiday house that we can all go to, etc. So we found a lender that was willing to accept a lend up to 80%.
Yeah.
Now, from a structuring perspective, this is where things get quite interesting because, again, I think I'm not speaking about individuals specifically, so we're not really talking about it, but the structure of purchasing this property was a hybrid trust structure, which is, again, generally not something that's accepted by most banks, because effectively we have a unit trust, we have bucket trusts underneath, which are each of the individual borrowers in this instance. So there was quite a bit of back and forth around structure, around approval, around acceptance with the given bank. And we were finally able to acquire a loan or get a loan approved to do this at 80%.
Does GST apply on flipping properties? The biggest $1 million question that everyone asks.
The answer is yes. It depends how you're structured, and it depends on the type of property and how much money you're injecting into those renovations. Look, really, my favorite types of deals, if you're going to do stuff and you want to keep it simple, there's plenty of profit in doing those low set, 3-bedroom, 2-bathroom, those 40 to 50-year-old display home project homes in areas where the location really works numbers wise, where there's a nice disparity between the unrenovated and renovated properties. So those properties will keep you out of trouble. They're just smaller renovations. They're cosmetic. You can make plenty of money out of those.
Where do you see the property market going, or property as an investment class? Talk to me about that and talk to us in relation to Australian mindset. And then what are you seeing outside? Because you do a lot of investing outside Australia as well.
In terms of where we see the outlook for property, there's a lot of risk around property that we see. In saying that, I think just because on the supply and demand side of things, what's going for property is really supply and demand. Outside of that, not much. So in terms of value creation, could supply, and if something were to change, so there is a huge risk on legislative risk that we're taking on with property that we're uncomfortable with. Because a single policy can change the environment quite quickly, whether it be from a tax point of view or whether it be from a capital injection point of view.
It's good and bad, both.
And there's good and bad.
Yeah.
And I know there's also increasingly pressure from the superannuation industry to enter to almost mandate them to enter the property market?
A financial advisor is basically like a project manager for you as an individual. They'll help you map out the future and then they'll help you implement things. So that could be to help you refinance a mortgage in conjunction with a mortgage broker. You could lay out a plan to buy properties. So for example, I've had a client where he was 50 and he said, James, I want to retire when I'm 60. I want to buy one property every year until I'm 60. And then when I'm 60, we'll sell 3 and then I'll have 7 properties with no debt. And so we modeled it from a cash flow perspective, looked at the tax outcomes. We had a look at interest rates. We had a look at the characteristics of the property. So do we need to go for growth properties or income properties to keep buying year after year? Because the more you buy, the bigger the loan is, the harder it is to get that next loan from the bank. So as a financial advisor, we're looking after everything with an individual person to basically help them make good decisions.
Now, hitting the 3-year mark doesn't mean that we are slowing down. This is just still the start of the journey. If anything, the next year is going to be bigger with more deep dive, more tactical episodes, and definitely more real raw conversations about what's happening in the market next year. We're going to start off the new year by talking about where to invest and where to look out for in 2026. To everyone who has listened, commented, shared, or messaged, your trust, your curiosity, your ambition, that all fuels me and the show. And if you have been here from the start, you guys rock. You are the one who basically get me out of bed. So thank you and welcome to the family. As we wrap up this anniversary episode and head into the holiday season, I wish you all a very warm, joyful, peaceful holiday season. Stay safe, stay humble, stay inspired, keep investing, take care, stay safe. This is Moss checking out. Adios.